I don't know about you, but for me, I like to learn by doing. When I put something new into practice, I see how I get it wrong, I learn how to do better, and then hopefully, eventually, over time, I get it right. At the same time, it's smarter to learn from other people. Nothing is new under the sun. Everybody has done these things before. And so, if we can learn how somebody has done it before us, maybe we can avoid certain mistakes and maybe we can pick up certain techniques before we get into practice ourselves. This implies to investing too. While your tuition will often be the mistakes you make at the beginning of your investing career, if you can learn from other people's mistakes and successes, you can get a sense of what to avoid and what you might do when the time comes. For that, I want to share a few examples from my own investing and then from famous investors on their investment ideas to see how things can go right and how things can go wrong, and to give you an idea of all these things we've talked about and how to buy stocks, how that looks in practice. We're going to start off with a recent investment I've made that is still undetermined whether it's a success or failure, but it's the freshest in mind in terms of the whole research process, so I thought it was a good place to start. I'm standing in front of or behind an office chair because we're talking about an office furniture company, Steelcase. Let's get into it. I'll start with how I found Steelcase, and then we'll go through the things that I look for in a company and in a stock, and we'll walk through the process of how I verified whether or not the company had it. How I found Steelcase starts in 2014, though I'll try to keep it short. I invested at the time in Kimball International, a company based in Indiana that was splitting itself in two. It was a furniture company, but also an electronic manufacturing company. It's going to split those two businesses into two in what's called a spin-off. I learned about spin-offs. I'd heard about them, but I learned about them in depth from Joel Greenblatt's You Can Be a Stock Market Genius Too. One of the most famous investing books out there, a must read. It's a fun read and it opens some new ideas. I read it, I wanted to put it into practice, and Kimball was the first one I tried it with. Kimball, conveniently enough, was a pretty small company, so it was under the radar, and the companies were the same size, the ones that they were splitting, so it made it a little bit harder to know where the opportunity was going to lie. It worked out pretty well. The electronic manufacturing company sold really cheaply in its first couple days. I bought it really cheap, and then I ended up making some good money on that. But at the same time, the furniture company dropped in value in the month or two following the spinoff, and so I bought a lot more shares there, and that became a position for me. It's an office furniture maker, and it worked out pretty well for its first 5 years that I held it. I bought shares, the extra shares in December 2014. I held shares through December 2019, added some shares over time as I had more money to invest and so on. And over that time, it returned 20% a year plus a 2% dividend, more or less, the stock price. So pretty good. No complaints. Of course, December 2019 got us to the COVID pandemic. The stock got hammered. And long story short, the whole industry struggled. Kimball eventually sold itself at the beginning of 2023, which was the only way that I ended up making any money on it. I would have been a loser in this stock if it had not been bought out by a bigger competitor, H&I. At that point, I was curious about the industry further. The market was at a point where most stocks were either way too expensive for what was ahead of them because they still had more after effects from the COVID pandemic or more reasons to struggle, and the stock wasn't reflecting that. Or the company was making a boatload of cash, but that was probably going to come down due to inflation calming down or other reasons. So it was really hard to find a company where the stock hadn't fully recovered and the company hadn't fully recovered, and there was room for upside. I did still think that office furniture was this sort of industry. I felt that way. That was why I was still holding Kimball shares. And now that I was bought out, I had to look for what else was out there. Were there other companies that I could consider? There are three major office furniture makers in the US that are publicly traded. There's H&I, which bought Kimball, Miller-Knoll, which is the combination of Herman Miller and Knoll. They merged in 2021 or 2022. And Steelcase. Steelcase based in Grand Rapids. I spent my summers in Michigan, a lot of these furniture companies around there, so I had some familiarity there. That's what led me to Steelcase. That's why I put it on my radar. From there, let's talk about what I was looking for in the company and how I did my research. I've said I want 4 things from a company. Revenue growth is the first one. And this wasn't really the case for Steelcase, or at least not in a traditional hockey stick type growth. for obvious reasons. The pandemic caused all of these office furniture companies to see sales decline in the first year or two after the pandemic because not as many companies were working in offices, so they didn't need as much office furniture. Makes perfect sense. They had recovered over the last year or two, but that was still a rebound recovery. They are still trading with have fewer sales than they did before the pandemic, most of these companies. Steelcase specifically is down about 14% in sales their last full year versus their last full pre-pandemic year. Meaningfully lower sales. And in the short term, Steelcase sales are not expected to grow this year. The company originally expected to grow slightly this year. They're now not expecting to grow. So I don't see revenue growth yet. At the same time, I think there is reason to believe there will be revenue growth. While we can all read different stories in the big national publications or in business publications about whether or not CEOs are going to win the battle to bring their workers back into the office, and I should say I'm a believer in remote work, so I'm not necessarily in favor of that, the CEO class winning that. I do think that 3 years from now, we're more likely to see more people working in offices than not. Steelcase specifically, as I studied, had a couple things work in their favor. Some reasonable diversification into other business lines like education. So they weren't putting all of their eggs in the office furniture return basket. And unlike Miller Knoll or H&I and Kimball, Steelcase didn't have a merger to integrate. I didn't have to worry about them dealing with the complications that come when you're combining two companies. I've gone through that. I've seen how it is. There's nothing secretive about this, but it's a tough thing to do. Steelcase could focus on its own business. I reviewed the transcripts. I reviewed earnings reports, 10Qs, 10Ks for Steelcase specifically, but then also transcripts, for example, for Miller Knoll. I reviewed the merger documents for Miller Knoll and H&I Kimball, and I got a sense that everybody was projecting a potential return to revenue of pre-COVID levels. Maybe volumes would be less, but there was inflation, whatever. There was hope that we could get back to revenue of pre-COVID levels. I don't know how long that will take, and I'm being more conservative than those merger documents were, or than Steelcase has been projecting itself. But that was a place I could start and something I could review to get a sense of what was possible. There's your revenue growth. The next thing I want is a business I can understand. Office furniture is not the most complicated business, and I had been following it for almost a decade. I'm diving more into the weeds as I'm researching a new company, but it was something I can understand. I can understand that you make office furniture, you sell it either through your dealers or you sell it in project format to big corporations. There are nuances. Steelcase is much more international than Kimball is or was. So I had to look in the international perspective. I had to look at the different smaller acquisitions Steelcase made. But the business itself is a pretty straightforward business. There's not too much that I need to understand that goes beyond some great technical knowledge that I don't have. That made me feel comfortable about Steelcase. And it's just an example of you can see things out in the world, you can connect dots from your own life. In my case, having already researched one stock and owned it for a long time, and where I lived in Michigan, being able to see and learn about the furniture history around me. That was also, gave you decent context. From there, I want to see control. Does the company have control of its destiny? Steelcase checked the box in one way. Its financial control, I thought, was fine. It didn't have a ton of debt, more debt than cash, but not a great deal more. Most of its debt isn't due for another 5 or 6 years, so there's no near-term need to pay off the debt. And the debt isn't very high interest rate. It's not super low, but it's not very high. So Steelcase isn't in an onerous financial condition. The company was also positive free cash flow last year, which is encouraging. Even though they didn't have a great year, they still produced positive free cash flow. They were negative free cash flow over the last 3 years, but that was really only because they built up a ton of inventory in the second year of the pandemic, which had to do with supply chain backups and hopes of the return to buying and so on. That's not great, but that inventory should unwind, all things considered, and they should make that money back. So I didn't feel too badly about that. The company was actually profitable every year of the pandemic, which is no trivial thing. All of that was encouraging. I'm not worried about bankruptcy. I'm not worried about Steelcase needing to go to the market to raise a ton of money. That was a plus. Operational control is harder. As we read about these companies and go through the research, it was clear that for one, all of these office furniture companies are dependent on broader trends that they don't really have a control over. Will the market for office furniture come back? Maybe, maybe not. Steelcase can't really snap their fingers and have that happen. So not a ton of control there. At the same time, I did some research into Hayworth, which is a private competitor to these other office furniture players, almost as big as them. Hayworth had a record year in 2022. That made me feel good that at least there is some demand out there, and potentially, if Steelcase implements the proper changes for profitability, for efficiency, for sales, whatever, they have levers they can pull to get more out of the current market. That's speculative. You have to believe what management's saying and so on, but I at least had that framework. The last point is related to that is efficiency. And Steelcase's efficiency had gotten worse, not surprisingly with the pandemic and inflation and so on. Gross margins had dropped all the way down to about 28.5%, if I remember correctly, versus 32.6% before the pandemic. That makes a big difference in your revenue, especially when their operating margins are normally only 7 or 8%. They drop now down to 3%. You need to get back to 7 or 8 for this to make sense. That said, Steelcase doesn't need a ton of capital expenditure. They don't need to turn all of the cash they generate into reinvesting in their business. That means that it can produce a lot of free cash flow, which is ultimately what I care about as an investor. Its margins were in line with competitors like Miller, Knoll, and H&I, so it wasn't like they were doing radically worse than everybody else. And sometimes bad is good because bad can turn into good. You fix bad, all of a sudden it's good. Everything works out from there. There was a clear path for Steelcase to implement their changes and to just make some more sales and see their gross margins go higher and their operating margins go higher. And if that happened, the company could go back to making more than $1 a share, which is where it was before the pandemic versus the 30 cents it made last year. You see that change, that's more than tripling in earnings. If that were to happen, when the stock was trading at about $7.50, $8 a share when I was looking at it, all of a sudden it doesn't take a lot for the stock to work, as we say, for it to go higher because the earnings are there. Efficiency wasn't a linchpin of the thesis now, but the possibility of improved efficiency was still there for me. Let's now talk about the stock. The first thing I want is an attractive valuation. And I just mentioned that if the company could make more than $1 a share at the share price of $7.50 or $7.75 when I was first buying, probably things would be pretty good. If they could sustainably make $1 a share, things would be amazingly good because the pressure will push the share price higher. It's not going to trade at an 8 times earnings multiple for very long. I can then do something like a discounted cash flow valuation, which we'll talk about at some point. I'll flash it on the screen just so you have an idea, but it's basically I try to model how much money do I think they're going to make in sales, where are their margins going to go, how much profit will be left over, and then when I get to how much free cash flow will they make each year, and it's a rough model, I can then say how much is that worth today. And if I model that the company gets back to that $1 a share or more in earnings by 2 or 3 years from now, the share price of $7.75 was really attractive. That's the bottom line there. So I thought from an attractive valuation, yes, Steelcase had it. In terms of relative valuation, I can stack it up again to 3 things. Against the stock market, Steelcase, even with depressed earnings from last year, was relatively competitive with the stock market. So I could say that it's trading at less than the S&P generally, especially if you factor in analyst estimates and so on. I was comfortable that I was getting a relative bargain compared to the market. Of course, if the market includes companies like Apple, Google, and so on, which are much better companies than Steelcase, I should be paying less for Steelcase. That's just how it should work. But I think there's a discount there. I can also see a discount compared to historic valuations. Steelcase used to trade at much higher numbers, both because it made more money, but also it seemed to be a more consistent, predictable business. Should it be able to put together a couple years of sales growth after this year, we could see earnings growth, and we could see the company be re-rated to a higher multiple. We've seen it in the past. There's obvious reason for the market to be skeptical now, which we'll talk about in a second, but the historic valuations were higher. Lastly, relative valuation compared to his peers. I'll throw up a little valuation comparison so you can see. It's hard because I've kind of kept it updated as share prices have moved on and so on. But Steelcase is at the very least not expensive compared to the companies you would stack it up against, and I would argue quite cheap on certain metrics. So again, I feel comfortable that in terms of relative valuation, there's no red wolf flags. The whole sector is battling. Whether or not Steelcase is the best play, we can argue, but if office furniture works, the absolute valuation is there, and within office furniture, I don't think I'm overpaying at the very least to look at Steelcase. The reason for all this disconnect is the most important thing almost, I would say, in all of this analysis. You need to understand what's going on. And for this, it's pretty clear. The stock market doesn't have a lot of faith in office furniture companies. Even as I was talking about this in public a little bit, I was seeing articles in the New York Times about office furniture graveyards. There's still, every day you'll see a new article arguing for the value of work from home and why work from office is never going to be the same, or you'll hear about CEOs still complaining they can't get their workers back in. There's still a lot of noise out there and signal out there, real information out there saying that we're not going to be in a 2019 environment anytime soon. That's an obvious reason to doubt these companies. I just think that there's a good chance that from 2019, you don't need to get all the way back there. You can just get to 2025 and be at close to 2019 levels, and it'll work out okay. So all of that is, you don't need a full return, and that's where I think I understand the disconnect pretty well. That because of where the stock is or was when I started buying, I don't need to be all the way at 2019. I just need to be better than today, and that's what I'm expecting. Then we have the risk reward. That's the last piece, and it's just as important. I've already said, I don't think bankruptcy is on the table. That's the worst case scenario. I feel like things would have to, we've already seen Steelcase at its absolute worst in the pandemic. I don't think we're going to retest that, and I don't even think the company would face bankruptcy if we did. That gives me some reassurance. From there, as I continue to look down, not up, and see what could go wrong, if Steelcase continues to be mired in the sort of earnings that they had last year, I could see the multiple getting lower, and I could see the stock, let's say, trading 10 to 12 times earnings, which would be quite low on 30 cents a share. That gets us down to $3.60 a share. 50% worse or more, a little bit worse than the current share price. It's a pretty extreme case. I wouldn't say that's what I expect, but let's call that our bear case. I want to have a reward that's at least 2 times that and feel like there's a good probability that the reward will play out. It's not just a shot in the dark. I've already said, if I see the company making more than $1 a share and consistently growing revenue and earnings again, a 15 time multiple isn't crazy. That gets us to $15 a share, which is more than double or roughly double the share price when I was starting to buy. I was getting more target prices in the high teens to low 20s range when I did the different valuations, because I think $1 is a low number for the earnings of what it could be. So that's the risk reward. I felt like it was more than 2 times reward to the risk that I was going to get. That was pretty attractive. More than 100% upside versus 50% in the low end downside. That seemed to work out okay for me. 50% is a bit extreme in terms of what I would normally want, and I think I'm exaggerating it a little bit, but that's what I was looking at for risk reward. All in all, I thought the stock checked all the boxes, and the company didn't check all the boxes, but you could see where the revenue growth was going to come. You can see how the efficiency can improve, and even if it will never have total control, it's not a trailblazer the way some companies are. I thought Steelcase was in a good situation to where it could benefit when things normalize. That's where I decided to invest. Let's talk about the investing process, the buying of the shares and how that worked out, and then where we are now. I've talked about when you buy a stock, you feel some emotions that you need to control. And I've also talked about how I like to stagger in my buys. I buy 50%, Then I wait for a drop, I buy another 25%, and then I wait for another drop and do the same. Just a technique to control those emotions and not put all my chips on the table all at once. Steelcase was an interesting example of that. I bought some shares on May 12th to May 15th at about $7.7, $7.6 a share. That was my first 50% buy. And then, like clockwork, on May 16th, all of a sudden the stock dropped to the high sixes. No reason. I couldn't find out why that happened. A little bit scary. I bought some of my next 25% there. The stock still lingered around there for a while, so I bought the rest of my 25% in the high sixes. And then there were still times where it got even to the mid sixes and I think even lower, though I couldn't find the numbers. And I said, I'm going to wait for now. I'm just going to be at 75% of my position. I don't have super confidence in my analysis, and I wanted to see how the company performs as a business before I go further. By the end of June, Steelcase reports their earnings at unusual times. They reported their earnings in June, and they were good, better than expected. They beat their earnings and revenue numbers. It was a decent report. It wasn't anything amazing, but the stock jumped a bit, came back down, but it did jump to the high sevens and then kind of grinded higher from there. We got a decent report from Miller Knoll in July, a decent report from H&I in August. There was some momentum in this industry for whatever reason. It could have just been traders seeing that things were moving higher because there weren't amazing numbers, but good enough. Steelcase then reported earnings again in September, and this time, even though they lowered their revenue guidance for the year, which was a yellow flag, and they also had their orders were negative year over year, another yellow flag, they raised their earnings guidance meaningfully. And they talked how they gotten the margins problem solved. The gross margins were back up towards those numbers from before the pandemic. And the stock popped. It went from, is already at the eights or low nines. It jumped all the way up to 10 and up to 11 that day. And most of the time since then, it's been above 11. As I record this, it's dropped back down to about 10.5. The point of what was happening in the business is that they would be able to, even on the lower revenue, make more money. And they continue to sound confident about we're in the stages of recovery. We think recovery is going to happen. Even though we're not growing our revenue this year due to some uncertainty, we still have confidence in our longer term outlook. What's the bottom line in all of this? It's too early to say if anything's right or wrong. The stock could easily drop back down just because of the market. The company could have a bad earnings report. There's no guarantee of anything going on. But I would say right now what we're seeing is not that the company argument was very strong yet. Revenue growth was sort of underlying. I do think that we're going to see more people in the office in the coming years than before. That hasn't played out yet, so no credit there. Where I can argue for credit is that I may have gotten some understanding of the stock was cheap enough that not a lot needed to go right for it to work. Sentiment had been really negative on Steelcase ever since it cut its dividend September of 2022. That's when it really took its last big drop. They have held their dividend steady. They're producing a ton of free cash flow right now as that inventory works off that I mentioned earlier. And so the financial stability is really strong. And now really all they need is to get a couple things right in terms of revenue growth, and things should really work nicely. Even as is, they're raising their earnings guidance quite a bit, which I mentioned and which is useful, but that's where that part of the thesis is right. Whether so far, I am not trying to overstate, but that seems to be playing out. The question of whether it will actually get revenue growth and whether the industry will deteriorate further instead, that's still to be determined. And that's going to ultimately decide whether this is a successful investment or not. It's just 4 or 5 months is a poor window to really make an assessment. We're almost 6 months now. Poor window to make an assessment on an investment idea. And what's hard is that even 2 or 3 years from now, it may be tricky to tell whether I was right, lucky, wrong, unlucky, what have you. We know it's still early, but that's how I'm following. That's what I'm watching for. I'm not adding more shares. The shares are mostly up, which, you take it. You'd rather have that than the opposite. But that's the story so far for Steelcase. I shared this as just an example of how you go from finding the idea to doing the research to what you want to see in the company to buying the stock and then what it feels like to buy the stock. It was the most present example I had. In my next video, I'll talk about another example. I haven't decided yet. Either I'll go to another stock that I bought and have sold and it has played out positively, or I'll use one of the negative examples I have. Either a stock I bought and I shouldn't have and I ended up paying the price, or even more interesting, maybe a company that I studied and understood really well didn't buy the stock and missed out on a big move. Stay tuned for that. That's coming next week, hopefully, if I get on schedule. So subscribe, follow, let me know if you have any questions, and thank you for watching. I will see you next time.